Warren Ingram, lots of people tweeting also about your book. Much excitement about your book, Warren Ingram. Is it finally out? Have you got a copy yet?
No, I don't.
Oh, come on. This is like we're being an expectant father, and you've gone past due date, and now I'm waiting.
And the baby's just not popping out.
Just not popping out.
So I thought I made myself a promise that I'd go and have a look at a couple of bookshops tomorrow to go and see if it's actually in the shops. But I suspect it'll be there on Monday.
It's How to Make Your First Million is the title of Warren's new book. And
I do have one piece of information.
Yes, one piece.
People were asking what the price was, and I didn't know, but I do know now it's going to be $220.
Cheap at the price. Cheap at the price.
Yeah.
George Mattia says, I'm busy with my third million. The first two didn't work out. So, George, read the book. Read the book. We're not laughing. We're laughing with you, George. He's got a sense of humor, George. Now, listen,
George.
It's happy birthday to index funds. They're 40 years old this year. They were started by a man in America, like many things are.
Yeah, it turns out to be a wonderful man by the name of John Bogle. And on the 31st of August, 1976, he started the first index fund. Had a very interesting name called the First Index Investment Trust. No prizes for originality. Mm-hmm. And the job was to track the S&P 500 index. So that's the index of the 500 biggest companies in America. And he was basically the laughingstock of the asset management industry. They really thought this was a huge hoot and something that just would never gain traction.
Because the idea of index investing, just for anybody who doesn't know, if you have a unit trust, you have a fund manager, a human being actively managing whether you've got this percentage of Naspers and that percentage of Anglo Gold and that percentage of Standard Bank, they charge you a fee for doing so. The index, and it depends on what the index is. Stop me anytime I get this wrong, Warren. If, say, it's the index of the top 40 shares, the most valuable shares on the JSE, well, it just buys the top 40 of the JSE in the proportions that they are. So 15% of the investment would be SAB, 15% roughly would be Naspers, and a smaller percentage right now would be Capitec, for example.
Exactly right. And so it's very efficient from a cost point of view because you don't need to pay fund managers to second guess the market. You obviously have an implementation team that has to make sure that they're managing the money that's coming in and out every day to buy those specific shares and reallocate dividend income, etc. So I'm not saying it's without skill, but it's something that can be done on a very large scale, extremely efficiently.
Now, it took a long time. Mr. Bogle was visionary. He created the first one, but it took a long time to gain acceptance.
Yeah, and his big dream, his sort of really big audacious goal was that he would hope that this could raise about $150 million one day. That was really what he was aiming for, and fortunately he was horribly wrong. But in the starting point, for the first 3 or 4 years of the investment's life, he just couldn't outperform the index at all. I mean, I think not outperform the index, but outperform his peers. About 75% of all the active funds, beat him in his first 3 or 4 years of life. But fortunately, things started to turn.
Because nowadays, the vast majority of actively managed funds where human beings intercede in the market and start making choices in the market, nowadays, most of those underperform the average, which is how the index performs.
Exactly. And I just went, it's quite hard to get the very long-term stats, but I looked at the last 10 years of especially this fund. It's changed its name. Now it's just called the Vanguard 500. Index fund, and over the last 10 years, it's outperformed something like 82% of all of its, actively managed competitors. So that's just an astounding stat. If you think about how many fund managers there are and how many of them are analyzing, the markets and trying to beat the markets, and here we've got this extremely low cost investment that's smashing most of them out the park.
Why is it such a hard sell then for people to accept? Because we're seeing more and more index funds gaining acceptance in the United States, and people are beginning to include index funds within broader investment strategies. In South Africa, though, it's the pension funds are beginning to wake up to the value of index investing. Not many private investors are.
I think you're right. I think it started to gain traction. So it's the sort of the snowball rolling down the hill. It takes a bit of time to build up some traction, and the more people like me just keep beating the drum endlessly and boring the pants off people, eventually somewhere along the line they start to listen and they start to see the benefits of these low costs, and then that starts to have an effect.
What's interesting is how the index changes. So Karen Richards, who's terribly helpful on so many things on social media, she's a technical share trader. She's an investor. She's a retired accountant. So she's smart as Karen Richards. And she tweeted a little box today from the JSE talking about companies that will be joining the top 40 index and companies that will be leaving the top 40 index on the 19th of September. And what's really interesting to my mind is to see two gold companies coming back into the top 40 index. There hasn't been gold in the top 40 index for years, but Goldfields and Sibanye making a comeback.
Yeah, absolutely, and that's that's the nature of the index. You don't buy the same 40 companies forever. You're buying a dynamic moving thing. But fortunately, it doesn't change every day or week. It's I think it's done quarterly, if I remember correctly.
I think so, yeah.
And so at least you do get exposure to what's going on in the economy. But I think it's also an interesting story to me because it's a story of how the asset management industry has adapted to this phenomenon. I can remember just in South Africa, the asset managers, I was quite outraged by how high their fees were and how dismissive they were of things like index investing. And now you find their fees are low, the asset managers, and they're much more humble now, I think, about the role that they play and in the role of passive investments in the market.
Here's my critique, though, of index funds in 30 seconds. I might not want to own a gold share, but now I buy the Satrix 40 and I get 2 gold shares. And I might want to actually take a value bet on Capital and Counties, which is now dropped out of the Satrix 40 because it's no longer valuable enough. And I might think that platinum's got a brighter future than gold has, and so I might want but Anglo Platinum's dropped out. And I quite like Rand Merchant Insurance because it's got outsurance and it's got a stake in Discovery and it's doing interesting things in the property sector, but that's also out of the top 40. I lose choice.
You do, and I think that's the point. Is that the debate of either or, I think, is gone. So to me, the ultimate is that you have the index. It's your core portfolio, and then you buy either individual shares that you really want, or you buy an active manager that looks nothing like the index that gives you that protection. Just the last comment there would be something like Naspers, which I've said many times I can't understand and I don't know how to value, so I'm not going to buy it. And fortunately, being an index investor, I've owned Naspers for a long time. Despite the fact that I wouldn't have bought it myself, and it's rewarded me very well for doing that.
You see, people with little faith can be rewarded. Warren Ingram, he's a financial advisor. He's a director at Galileo Capital.